A callable bond is a type of bond that can be redeemed by the issuer prior to its maturity date. The issuer has the right, but not the obligation, to call the bond and repay the bondholder the face value of the bond plus any accrued interest. Callable bonds are typically issued with higher coupon rates than non-callable bonds, to compensate investors for the added risk that the bond may be called before its maturity. The call feature on a bond is typically included as a way for the issuer to manage its debt obligations. If interest rates decline, the issuer can call its bonds and issue new bonds at a lower interest rate, reducing its overall interest expense. However, if interest rates rise, the issuer is unlikely to call the bond, as it would have to issue new bonds at a higher interest rate, increasing its interest expense. Callable bonds are typically issued with a call protection period, during which the bond cannot be called by the issuer. This period is typically 5 to 10 years, but can vary depending on the terms of the bond. After the call protection period expires, the issuer can call the bond at any time. Callable bonds can be attractive to investors who are looking for higher yields, but are willing to accept the risk that the bond may be called before its maturity date. Callable bonds can also be useful for portfolio managers who want to manage the duration of their bond portfolio. If interest rates are expected to decline, the portfolio manager may choose to invest in callable bonds to take advantage of potential capital gains if the bond is called. However, there are risks associated with investing in callable bonds. One risk is that if the bond is called, the investor may not be able to reinvest the proceeds at the same interest rate as the callable bond, potentially lowering their overall return. Additionally, if interest rates rise, the bond may not be called, and the investor may be left with a lower yield than they would have received from a non-callable bond. Callable bonds are a type of bond that offer higher yields than non-callable bonds, but also come with added risk. They can be attractive to investors who are willing to accept this risk, and can be useful for portfolio managers looking to manage the duration of their bond portfolio. However, investors should carefully consider the risks associated with investing in callable bonds before making an investment decision.